All right, we'll call the meeting to order and welcome you to the April 11th meeting for the Oklahoma City Post-Employment Benefits Trust. The first item of business is approval of the minutes from the March 14th meeting. All in favor? Aye. Any opposed? Next is to receive the monthly preliminary performance report, and then also we have a presentation on trustee questions. So we'll go ahead and hit the preliminary investment report first with Doug. Appreciate you being here with us today.
Good morning, Mr. Chairman and trustees. If you will open the monthly performance report, I do apologize. It appears that the market environment printed out a little bit oddly on this end, so it's difficult to read. But if you look at this table right here on the right-hand side, look at performance for the month of March was quite good. U.S. equities were up almost 7% as the broad large cap market. And then going down to the Russell 2000 small cap stocks up almost 8%. So a very widespread rally amongst U.S. equities, and one that did favor some of the more risky or aggressive companies out there. And then looking at international equity, which is a source of several of the questions, you'll also note that international equities were up almost 8%. Fixed income up a modest but still positive 0.92, and then global aggregate ex-U.S. dollars, so those are foreign denominated bonds, up 4% on the month, which is a very clear signal that the U.S. dollar actually weakened during the month, which helped you if you held bonds in foreign currencies. Now that's been a real switch. That's been a tremendous change of what we saw last year, as the U.S. dollar was truly seen as the reserve currency of the world, and in an uncertain state, U.S. dollar appreciated, which hurt you if you held non-U.S. denominated investments of any kind. So the second page of our report did print out very clearly, and I'm happy to say that the portfolio did well during the month. You see the market value at the top, $37.2 million, which is truly dramatic growth if you just step back and think that it became a trust in 2008 and really started moving along starting in a very difficult period of time, and we have increased the sophistication of the portfolio over that time. But the contributions are truly the source of most of the growth here. If we look for the month, the total fund was up 5.84%, so that's a great result, one we've been waiting to see for quite some time. Not only that, it did outperform the policy index, which is something we've been impatiently waiting on. It's been a tough market for active managers across the board, especially amongst U.S. equities, as there have been many cross currents there. And we've also seen the ETFs and the passive management performing very well versus actives prior to this period. Now, that did lead us to make some fairly significant changes to the portfolio over recent years, which was allocating more to passive management, but still having a good core of active managers to add value over time. So if we look for the month, 5.84%. Going down the list, you'll see our active managers performed well. Those who are most aggressive performed the best. So a firm that we've been very concerned about their performance, not about the firm itself, has been Loomis Sales Bond Fund at $4.49 million, 12% of the portfolio. Underperformed last year due to some more aggressive positions that they've held, not only in non-dollar, but also in below investment grade securities. And for the month, they were up 5.29%, outperforming their benchmark, which was less than 1%. Next below them, you see Double Line Bond, which is a more mainstream or less aggressive bond manager, and they're hired with that clear intent, up 1.25% for the month, and versus 0.92 for that benchmark as well. Looking back over the last year, clear outperformance of Loomis Sales, but again, a difficult time if you've taken any non-benchmark risk in the portfolio to outperform. Lord Abbett High Yield is our very cautious high yield manager, and for the month they've posted a really nice return, 3.82. But when you see rallies, when you see markets turn around very quickly like this, sometimes your more cautious managers on the high yield side will underperform, and you can see that they did perform nice on absolute terms, but on relative terms they did underperform. Over the last 1 year, a very difficult time for high yield managers, down 3.2% versus a loss of 4% for the benchmark. High yield markets have been very fixated on energy prices, materials, et cetera, because those are the biggest issuers of high yield over recent periods. And we feel that Lord Abbett has excellent insight into those two sectors of the market, and we are seeing them branch out into new investments within both energy, on the E&P side, on the midstream side, then also some materials, but they're doing very, very cautiously. Hoisington, our duration manager, or our active duration manager, for the month underperformed, but looking over the last quarter, up 9%. And remember, this is our hedge towards volatility, and they definitely did that this quarter. I think that looking forward may have some case to actually increase the size of their allocation with the full expectation that they're much more volatile than the market, than the bond market itself, but in the right direction when we do need them. So a 9% return there. For the quarter is our top performer with a portfolio that's composed only of Treasury bonds and only of 30-year Treasuries right now. So asking them how much lower 30-year or Treasury interest rates could go. I apologize if I'm repeating myself, but as you know, 30-year Treasury is down below around 2.7% for a 30-year Treasury. That's all you're paid in interest per year. Asking Hoisington, who make their entire research process based on interest rates, how low U.S. interest rates could go, their response is, if you look at Japan and Germany, they're at 1% on the 30-year bond. And they've got great deals of their government bonds throughout the world are now trading at negative interest rates, which I think is difficult for me to conceive of, but having someone that's so smart on interest rates, I think, is a great allocation in this portfolio. Going down to our equities, you'll see the index fund is performing exactly how it should, up almost a little bit more than 6.75% for the month. Dreyfus Appreciation also performing nicely, not only in the month, but the quarter. You can see that they outperformed their benchmark. And again, this is a unique portfolio that's built to invest only in large cap companies, very largest large cap. So it is a blue chip portfolio that doesn't look a lot like any others out there, but provides return potential, provides wide diversification, and a great deal of yield. Our mid cap index fund, you can see, performing very nicely for the month. Hotchkiss & Wiley, another fund that we've been a little bit worried about their performance, not about the firm, but the performance turned in a 13.5% return for the month. And remember, they started last year moving into very underappreciated energy companies with part of their portfolio. And we'll talk more about them and their allocations in a few moments. Our small cap growth portfolio, again, fairly as it comes to small cap growth managers, very cautious, and their return was 7.4 for the month. And then Causeway, our international equity, tough market, but they did put up a 5.09%. Remember that they do have allocations not only to Europe, but also to Japan and some emerging markets exposure, which it's been early, but we still think emerging markets has exceptional performance potential going forward. Happy to take any questions about any of these firms, the portfolio, its allocation.
I'm just curious. I'm looking at the significant overperformance by some of the managers who have been underperforming for a period of time. What do you attribute that to?
Well, it's to, when we think about the active managers here, one thing that we look for long-term investors. And when markets get dislocated like they were last year, when they're very volatile and for what we consider more short-term reasons, you know, these are big macro issues, right, that are causing the entire market to sell off. You know, it's if China says that their growth is slowing down significantly, the entire market sells off. And what that allows these firms to do is to upgrade their portfolios into the bigger, more attractive values that they see out there. So they can go from a company that they've held for a while that they think is maybe 20% undervalued, and they can swap it out for a company that's just as attractive to them, but it's 40% undervalued. And so when markets snap back quickly like they do, when they start to recognize value of individual companies rather than discounting market worries, then the rationality of these processes works, and it's evident. And again, this is something we've seen many, many times with these firms. Hotchkiss & Wiley, we saw them in 08, 09 sell off dramatically. We've seen them even all the way back to 2000 with the internet bubble, and you remember what was it, when everybody thought that their computers weren't going to work after we went from 1999 to 2000. And I mean, it's these great macro issues that push down the entire marketplace, but it really exposes value in attractive companies where if you're patient and you do your homework and you get to understand companies and what drives them, then you can realize some exceptional returns. Now, again, we don't expect this every month from them. Over the long term, we expect it to elevate them above their benchmark. But remember, we've got a couple of shock absorbers here. We love equities long term. We think that you earn a lot more owning companies rather than loaning money. And that's why we have an overweight, or not an overweight, but a significant allocation to equities. But for those periods where active management does not work, and it is cyclical, we have the two allocations to the Vanguard 500 index and then also the mid-cap index as well, to help us maybe with our courage and patience on the active managers on those times it's very difficult. So, one, I want to say thank you for having the patience to go through this period of time. I know it's not always easy, but over the long term, our belief, and the evidence is there, that good, solid, active managers who don't trade too much, who get to know companies, can outperform over the long term. Short term, it can be a pretty bumpy ride, but over the long term, these firms will, I can't guarantee it by any means, but with no significant changes to the organizations or the investment philosophies, we believe that they can provide the return above their fees that more than justifies some of the short-term issues that we might have with them.
I know that some of these companies haven't been a part of our portfolio for very long, at least for a 3 or 5 year period, but is it possible for you to provide us with that performance information for like Hotchkiss and Wiley for the 3 and 5 year periods?
Yes, and I'm glad you asked that question. We can move right into the next notion, which is that question is one of the ones that we addressed, and thank you. I love this format where we have questions and we get to answer them and have time to think about them and put something down on paper. So if you'll look at our trustees' questions and answers, we were given a list of questions, and she's not here today, but Lori was very helpful with all of this, getting them to us. And so if we'll look here, one, to answer your question, Trustee Barry, can long-term returns of managers be displayed? And yes, they can be. Long-term performance has been added to the monthly and quarterly reports. Unfortunately, not for this one. This is a very quick turnaround. It's pretty early in the month. We wanted to get the data to you already, but I have already reviewed the report for the end of the quarter, the format that's going to be coming out, and it will include those figures for you. And I know that's very helpful to you, but it's extremely helpful to us as well. So to answer that question, yes. Page 2, how many of the funds have international exposure? And a few months ago, let's just remember that international was hurting our returns. Last month, international was helping our returns. And while it's a little bit difficult to read in just grayscale here, on page 4, we have all the equity portfolios and the equity composite. You'll see the S&P 500 has 1% non-U.S. equity exposure. Dreyfus appreciation, that's cash. So it's 99% U.S. equities, because the definition of the index is you have to be domiciled within the U.S. Looking at Dreyfus appreciation, they're also investing overseas, 20% of their portfolio. Those are in mega cap companies, so you're looking at Nestle's and companies of that type. We look at our mid-cap index funds, 98% U.S. equity exposure. You look at Hotchkiss and Wiley, 17% in non-U.S., and that's unusual for them. It's higher than we have seen them in the recent past, but one of the things that they're finding are non-U.S. based energy companies have sold off even worse than ours, as well as a few non-U.S. based banks. Stevens Small Cap is very small non-U.S. exposure. Causeway is 99% international exposure, as we would expect. So when we break down the equity composite, 78% of our exposure to equities is U.S. based, 21% non-U.S. based, and we've got 2% cash allocation overall. So that breaks down the equity exposure into 3/4, more than 3/4 is in U.S. equities and 21% in non-U.S. We're comfortable with that. When you start getting over 21, over 20% up to 25 or 30. That's a pretty significant risk in your portfolio. But as we look at the markets right now, U.S. equities have recovered nicely. We think there's significant value in non-U.S. equities, both developed and emerging markets, due to recent.
Black and white
Yes.
document that I'm looking at. So it's very difficult to tell which is U.S. and which is non-U.S.
Correct.
Equities. So can you tell me again where the U.S. and versus non-U.S. is reflected on the page?
Absolutely. And I'll add a data table to this one next time so it's more legible. So if you look at the Vanguard 500 index, 99% U.S. equities, 1% cash. Dreyfus appreciation, 79% U.S., 20% non-U.S., 1% cash. The Vanguard Mid-Cap Index is 98% U.S. equities, 2% non-U.S. Hotchkiss and Wiley, I don't know why we don't have that 83% U.S. equities, 17% non. Stevens Small Cap is 94% U.S., 1% non-U.S., 6% cash. Causeway, yeah, that's really tricky. 99% non-U.S. equities, 1% cash. And so when you go to the composite, we've got 78% equity exposure is U.S.-based, 21% non, and 2% cash overall. And we will be adding this table, if you would like, or this chart to the quarterly report. We think it's good information to have. So looking on page 5, this is the U.S., non-U.S. fixed income exposure, and this one will probably be a little bit more surprising given the fact that bond markets have become more and more international, interest rates more and more internationally influenced. So Loomis Sayles Bond Fund is 66% U.S. fixed income, 34% non-U.S., and that's a great deal of their performance last month came from that non-U.S. exposure. The downside to that was performance last year. It was also a great deal of their underperformance was due to non-U.S. exposure, but patience has definitely paid off there. The Double Line Bond Fund, 83% U.S. fixed income, 17% non. Lord Abbott, 80-20. Hoisington, as you would expect, 100% U.S. Treasuries. That's all they ever buy. And that's 100% U.S. long Treasury bonds. And the composite breaks out to 78% U.S., 22% non-U.S., which is pretty darn close to what we're looking at on the domestic side as well. So fairly close U.S. non-U.S. exposure. Sector weightings for each fund, and this one, I do apologize, this may be better as a table than a chart, but you will see on all of these, as we start with basic materials and going to utilities, it's very difficult to read. I do apologize. I'm going to send this back over with a data table or just as a data table to make this much more legible. Okay.
And I do apologize. We should have printed these out in color. We do have that capability now. We'll actually send you all a color copy of these.
Great.
Thanks, Bob. We print everything out on color, and I do apologize for not thinking about that. That makes it tough to read. But rather than try to wade through all of these numbers, if you look on the right-hand side, please note it's a very diversified portfolio. And we're classifying not only the domestic equity, but the international equity in the composite as well. So you've got a very, very diversified portfolio. Not an overweight, significant overweight to real estate or to healthcare or to industrials or energy, but we're seeing the value-oriented managers more and more interested in energy. And if you look at some parts of the marketplace, the earnings of one part of the energy sector that I look at very closely are master limited partnerships. Earnings were down last year, 13%, but the average share price was down over 40. So there's disconnects, and there's a lot of value.
Through each one of those, but if you could just go through the composite weightings, that would be great.
So, and I'm trying to translate here, bear with me please. But when I look at basic materials on the left-hand side, and then consumer cyclicals, that looks like those two are definitely at the bottom of the column there on the right-hand side. So basic materials at 3%, consumer cyclical at 12%, financial services at 14%, which is hard to believe because before the great financial crisis, financial services would have been 30+% of any diversified portfolio that looks somewhat like an index. Real estate at 2%, communication services at 4%, energy at 8%, which is down by more than half over the last 2 years. The next one is industrials, which I believe is 11%. Technology, 18%. Healthcare, 13%. Is that right? 13%, and utilities at 3%. Yeah, so I think that's consumer defensive is the one I didn't say. Consumer defensive at 13%, and then healthcare at 13%, and utilities at 3%. Consumer defensive, that's, those are, it used to be called consumer staples. Did you say what are they or where are they? Those are things that you have to buy. So it's laundry detergent, things that have very sticky demand. So they're non-cyclical things that we all as households have to buy.
So consumer cyclical is going to be like discretionary.
I think anything bigger than a refrigerator.
Okay.
It's sort of a rule of thumb. And again, this is not a very grayscale friendly chart. I do apologize for that. But also note that the whole portfolio shakes out as very diversified. But when we're looking at our active managers, say like a Hotchkiss and Wiley, they have distinct differences to the portfolio, and that's really what they're paid to do. They're not paid to look like a benchmark. They're paid to be the benchmark. And another old rule of thumb is that you can't be the benchmark and beat the benchmark at the same time. So they're finding value in normally the most unpopular parts of the marketplace. And that's something they've done for decades. Oh, thank you so much. Bob very thankfully found it on his phone where it's color. I can see here. So, for instance, on Hotchkiss and Wiley, you see that basic materials, they have nothing. Consumer cyclicals, they have 19%. Financial services, they have 27%, which a lot of those are mid-sized insurance companies and banks. And they have increased their energy exposure to 17%, which is double almost any of the others. Now, on page 9, if there are no more questions about page 8, is another very specific question. Is there a reason Hotchkiss and Wiley has very little healthcare exposure? And so I submitted this question to Stan Major, the portfolio manager, and he responded here and said that, and this is in quotes, our underweight exposure to healthcare is a reflection of the opportunities available in the current marketplace as opposed to a chronic underweight position. In the past, we have been overweight healthcare at times and had notable positions in pharma, equipment, healthcare technology, and managed care companies, so across the entire spectrum. In today's environment, we find few interesting opportunities in healthcare relative to the rest of the market, and the bullet points state how they narrow the healthcare market down in their mid-cap part of the U.S. equity market. So there are 242 healthcare stocks that have a market cap in their area, which is $500 million to $20 billion. 14 of these have a forward PE of less than 12 times, which is one of their cutoffs for companies they figure are attractive on a valuation basis. So healthcare companies at times like today sell for very high multiples, and that's not something that they are comfortable with. 9 of those companies are specialty pharma or biotech. Again, very concentrated drug portfolios and huge reimbursement risks for these. The remaining 5 are providers or equipment companies that carry more leverage than they're comfortable with, 30 or to 80% net debt to enterprise value, and also have reimbursement risk. So what they have shown in this series is, starting with 242, how they narrow down the investable universe in healthcare companies and explain why they're not investing heavily in the marketplace right now. So they go from 242 down to 14 based on price only. And then below that, they have 9 qualitative reasons because of company-specific structural issues. And then they have 5, the remaining 5 from there, they eliminate because they're too leveraged and they're too risky from a financial structure perspective. Now, the historical allocation at the bottom here, you can see that in the past, the historical allocation versus their benchmark. So you go back to 2008, they had 7% allocation versus 5% for their benchmark. And you will see that as we go across the table here to 2014, just how much that grew as a percentage of the benchmark. And so as it's growing as a part of the benchmark, because those companies are becoming larger and larger, it's not unusual to see Hotchkiss and Wiley taking profits and reducing their exposure. And then 2015 and today, 0% exposure. Remember, the healthcare market last year, especially the first half of the year, was very biotech-driven. And then you hear the valiant pharmaceutical stories out there, very aggressive managements, trying to pile on as much leverage as possible because it was the hottest area of the marketplace. And again, Hotchkiss is very contrarian, and they're very insistent on strong valuation to support their investment thesis. So they're not going to be going into those companies as they get more and more expensive.
It's gotta be like right here.
Page 5, how are our managers performing compared to the fees that we're paying? And again, this is something that we focus on. Something I learned very early on in the business is that when you're looking at investment managers, they won't guarantee anything other than what their fee will be. Performance won't be guaranteed ever, but they will tell you what the fee is. This is a page from our report, our quarterly report, showing that the total management fee, the composite level, is 67 basis points. So we have selected a group of managers who, on the whole, have very low management fees compared to their peers.
The Arts Festival. Or, not the Arts Festival, but...
Don't know where that's going from. I thought I heard something, and I thought,
Which
where's the
street?
mic on?
Art?
So looking down this list, we compare Vanguard 500 Index, 17 basis points. Category average, and this is going to be versus passive funds, is 55 basis points. So we don't have manager risk there. We don't have active management risk, but it's still very attractive. Going down to Dreyfus Appreciation is 14 basis points lower. Hotchkiss, 22 basis points lower. Now, again, when we're looking at this is not the only thing we look at. And yes, last year was a difficult year for active managers, and particularly for the brands of active managers that we favor. Again, long-term valuation-oriented firms, both on the growth and the value side. So last year, did our active management fees pay off? No, they did not. Long-term, yes, we do expect them to, though. We love this page, and from a fiduciary perspective, we think that it's very important that we keep an eye on this. And the big question is it worthwhile to invest in active management? Last year, that was a tough answer. It was very difficult. Long term, I think that if you find the right firms, it's absolutely worthwhile. Is Hotchkiss & Wiley's strategy working? Yes, it is. Sometimes it does take some patience. And again, returns as of March 31, we looked at this already for the last month. You see them 13% last year. With that 1 month of return, they improved their result versus the benchmark to actually outperforming, and these are all net of fees. However, over the last 1 year, yes, they underperformed. And again, in a down market, we have seen them multiple times investing in companies as they become less and less appreciated by the marketplace. They never hit the bottom as far as buying at the very lowest point of price, but they do try to get fairly close. And again, last year, no healthcare exposure. building and energy exposure through the second half of the year did cause them to underperform. But Hotchkiss & Wiley, one of the best, deepest research-driven firms that we know of, and Stan Major, the portfolio manager, really does know what he's doing over the long term. So if we looked at these results longer and longer term, yes, it would look positive. And then Hotchkiss & Wiley peer universe comparison on page 12. So what we show here is them versus the peer group, which is mid-cap value equities, and this is going back from 2005, year by year, versus their benchmark, and versus the peer universe. So each of these columns shows you how mid-cap value equity managers performed, the spread from the top to the best performing to the worst performing. Actually, it's the 5th percentile to the 95th. Now, Hotchkiss & Wiley is going to be the dot. Is that right? It's very difficult to see here. If I'm looking at 2005, 2006, 2007, 2008, and then 2009, so they are the square, actually.
Yeah, I think they are.
They are the square. 2008 was very painful. 2007, I'm glad that we weren't invested with them here at that point, because they did learn a great lesson about owning home builders, which propelled their returns to extremely excellent returns on 2004 and 2003. But coming out of the downturn 2009, you see how well they performed. And when they're above the top of the columns there, that means that they're in anywhere from the 1st to the 5th percentile. So you see that Hotchkiss & Wiley, volatile on a relative basis. You can see that they tend to not crowd around the middle very often, but their process aims for truly excellent long-term returns. And there is some volatility, but you are paid off on periods like 2009, 2012, 2010, 2013.
So do you know, if you looked at this cumulative during that period, what it looks like compared to the peer group?
Yeah, so if you take them all the way back to inception, their outperformance is significant. There are gaps, right? I mean, they do build over time, and then you'll have a period like 2008 where, my favorite way to look at it is one where you have two lines, right, of performance, and growth of $1, if you will, or $10,000. So you start here, the benchmark is here, and then Hotchkiss & Wiley is. And if you have them long enough, the compounding effect of those added returns can be truly breathtaking. There are periods where they sort of backslide and go back closer to the benchmark, but usually after those, performance comes out like 2009 or 2013 or 2012, where it's just remarkable how strong their results can be.
Yeah, do you know how it compared for how Hotchkiss compared to the peer universe for 2015?
Yeah, so 2015, they were poor. I mean, the results were definitely below median. And again, this is one of those, if you look at, so historical precedent, this won't be repeated exactly, but it should rhyme. A period like 2008 to 2009, where they underperformed during 08, both the index and their peers, but then when they bounce back, it's remarkable. Top percentile, outperforming the benchmark. Let's just take a look. Didn't talk about the scale on the left-hand side here, but if you look at the returns, 0 is slightly below half, and then the returns go from, the scale is really big on this. So 20% return, 40% return, 60% return, 80% return. So when you're looking at 2008, yes, they were down more than 40%, but most managers were down that much. You see how compressed that bar is. You look at 2009, and that was a 55% return for the same portfolio, essentially. You look at 2010, that's a 35+% return right there. You look at 2012. I mean, the top of the universe was barely more than 20%, but they were more than.
Okay, you sure?
Was it me?
All right, so make sure.
Okay, so apparently what is happening is that the Arts Festival radios are bleeding over into our wireless microphone. So we took our wireless microphone, but we have a wireless receiver that is going to feed us for a little while until we're done, and then they'll try to work on it. So.
Makes it a little bit more fun.
Yeah.
Yes.
We're testing it out to make sure this isn't going on tomorrow at council meetings.
Guinea pig, right?
Yeah, that's right. That's
Yeah.
right. So thank you, Doug, for testing that for us.
Thank you for being our guinea pig.
You know, that could have been a very embarrassing moment for me.
Yeah.
So, Trustee Johnson, thank you for the explanation there. So I guess the story this page is telling is that Hotchkiss and Wiley does occasionally underperform, and it's traditionally in difficult markets like we had last year. But with the patience of living with them through those markets, the results can be truly breathtaking. Fantastic returns that are that you can say by looking at this chart are without peer during up markets because they're above the top end of their peer universe. And again, they're a measured allocation. And one of the things we need to remember is when they do outperform, you need to take profits from them. And then once we do that a couple of times, it becomes very reflexive to when they're underperforming to add more to their portfolio as well. Does that answer everyone's questions? And then peer universe comparisons on page 13. This is an important question, and yes, this last quarter was sort of a transitional period for our performance reporting, and we're very much getting it on board, and we're able to have answer these secondary questions that are coming up like this. And so yes, we will have full peer universe comparisons. What we're working towards, and we're not quite there yet, is a peer universe of Opebt trusts. Because the way that you look as a public Opebt trust is very different than a public pension plan. And so your performance, your portfolio structures are usually different. And so we're trying to match it up to have a true apples to apples, and it might be a couple of quarters until we get there. But that's the end state we're looking for.
So what's the difference in how we would structure for a pension trust versus an Opebt trust?
Well, it's funny, we were kind of talking about this in a slightly different way. If you have a pension plan that started in 1960 versus an Opebt trust that started in 2008, it's going to be reflective of that difference in time, right? So we would say even at the market value that you're at, this portfolio is in its, how should I say this, it's late adolescence. I mean, we went from essentially 3 portfolios to the structure we have now, and it's, in some ways, that's one thing.
So not so much that you would structure an Opebt portfolio differently than a pension, but more that because of the timing. Like if we'd had an Opebt portfolio the entire time through the life of the city, like we have with our employee retirement system,
right,
it would just be a more mature portfolio. So not that Opebt and pension are different, but more of timing.
Well, okay, I'm going to put a caveat on that as well. So 2008, you had Opebt trusts coming in. These are big liabilities, right? They're very underfunded in most cases, right? According to pension plans, tough funding's there as well, but as far as Opebt trust funding, it's on a sort of different time frame. It's pay as you go more than working towards actuarial liability. So in a sense, also as an industry, that's maturing as well. So some Opebt trusts came out very early and said, we're not going to risk any principal whatsoever. So we're going to be 100% fixed income. Other ones said, we have to take a lot of risk. So we're going to be 100% equities. Very rare to see either of those, but how groups like yourselves are addressing the nature of their liability is also different than the way pension plans are. I mean, if you think about it, this is another topic we're talking about, is that if you look at actuaries in 2008, 2010, come take a look at our Opebt trust. And a lot of the cases, it was, what? We don't know how to look at that. Mm-hmm. And you look at today, it's a very competitive market for actuaries to look at Opebt trusts because they understand them much better. And there are the guidelines and best practices that exist now that simply didn't 2008, 2010. So there's two sides to that, right? It's like, what is the best practices of how to invest these portfolios versus the maturity process of building up equity over time. So they're very different from pension plans. I mean, it's almost as different from public pension plans as corporate pension plans are. You know, they're moving in a totally different direction than most public funds right now. So we think it's better if we can get there. It's a tough process, though.
Now, I had a question, and I don't know if I'm going to phrase this the right way, but I thought when we were looking at the peer universe comparisons, we were not only looking at investing other Opebt trusts and what they were investing in, but we were looking at our managers.
Yes.
So is that going to be some additional information that we...
Go for it.
So we'll be, the report, I mean, if you see the...
No, look at this.
That's quick. That's like instant.
The quarterly reports had those in the past, and those will be in the new reports as well. And what I want to make sure is not only have the universes, but also have the extended periods of returns that go out as well. So
Back to doing just the historic Doppler radar images.
That is.
Yeah.
Oh.
So Robbie, who you're going to interview after me then, I guess for the election.
It may pick it up if we're on too, right? I mean, obviously. Okay.
So that is the final question we were asked to respond to, and hopefully we've done in a very complete and comprehensive way. And again, this is, I love this format. It gives us time to put it together and gives time for you to have new questions, and we're always happy to make this a part of our ongoing meeting process. And then also when we meet as the investment committee, I mean, it's a great time to air these as well. So more and more and more. There's so many issues here, and we want to make sure that we're covering them adequately because this is an important pool of assets, and it's an important responsibility that we all have.
Doug, I really appreciate you providing it in this format so that we can ask the questions in advance and you can be prepared to respond at the next meeting. I think this is a great format. Thank you.
Excellent. Well, thank you very much.
All right, are there any other questions? Thank you, Doug. Appreciate it.
Thank you, Mr. Chairman and trustees.
Yeah. If I could get a motion to receive the preliminary performance, receive the preliminary performance report.
So moved.
All in favor?
Aye.
Any opposed? And then item 4, to receive the trustee questions and answers report. All in favor? Any opposed? We don't have anything on item 5. Item 6 is approval of the request for proposals for actuarial services, and this is just something that periodically we come back and do. We're trying to figure out before the meeting, and I think we said we've had them, Nyhart, since 2010, and so it's not any issue that we've had with them. We just come back and renew and go through a new process, competitive process, periodically, and so we're sending this out. When are the proposals due back? What was the time on that? The 10th? Okay. So our goal will be to try to have them in place for July 1, will be the goal. And it doesn't mean necessarily that we change. It could be that Nyhart, we stay with Nyhart, but we'll go through the process and evaluate. And so I appreciate Bob and his folks stepping up to manage that. In the past, we had accounting services managing that, and really it started back when we were only doing it as a financial reporting tool. Well, now we're using it really as a part of the trust and how we value the trust and where we stand and what our position is. And so I appreciate Bob's folks stepping into that. And they have a little bit different perspective on that than you do from just a financial reporting perspective. So I appreciate them managing this on our behalf. So I'd take a motion on approving the RFP. All in favor? Any opposed? Next item is to ratify claims listings. All in favor? Any opposed? Any reports or comments from the trustees or staff? Bob, you guys have anything? Anyone else? All right, then we are adjourned.